The purpose is just to quickly outline what's going on with inflation, and I'll try to keep it short. We can have questions at the end, and let's just start off with a headline number. So the headline number is 4.6% for inflation. Many people were expecting 4.8%, and why? Well, we'll kind of dig into the details of why the numbers come down, but a large proportion of that is due to the way we price energy in the UK. We've got the price cap, and that makes it kind of blocky, and the year-on-year change is very large as a result, both going up and coming down. So let's look at the actual benefits of it initially as well, which is that if you look at wage growth in the UK, it's now looking pretty positive. Wage growth is growing at about 7.7% on average in the UK, and if inflation's now fallen to around 4.6%, well, that means that we've got a fairly chunky 3% real growth in wages year on year. The drawback of high wage growth is that the sticky component of inflation is services inflation, and service inflation is driven by wage growth. So that means that unless this wage growth number comes down, then we're likely to see sticky inflation for some time to come. But still, there's no question that this is a positive outturn economically. And this never gets old. This is one I used, a tweet I used from July, where the Daily Express was saying that prices must drop now inflation has fallen. Of course, many people will know, regular listeners will know, that inflation is a year-on-year change. And if the number falls, it just means that prices are rising more slowly. So all we're seeing is a slower year-on-year rise in prices. So let's dig into the actual numbers. So we've got two different ways of looking at inflation. We've got core CPI, which strips out the volatile components, which is food and energy. Why do we do that? Well, that's a better predictor of what future inflation will be. That's because, firstly, the central bank can't control energy prices. To some extent, it can control food prices, but also the fact is that they're very floppy in terms of how much they change over time, and they make the overall CPI number, the headline CPI number as it's called, the blue line you can see here, they make it more volatile. So by stripping that out, you get a better predictor of future inflation, which helps steer policy. So the Bank of England can set the rate based on core, and it's more likely to pay attention to core than headline. So headline inflation's come down because of energy, as we said. If we look at the last three prints, you can see that headline has gone from 6.7% in August down to 4.6%. So a 2 percentage point fall is absolutely huge. Core CPI, on the other hand, has gone from about 6.2 to 5.7, so about a 0.5 percentage point fall, much smaller. If we look at other components, for example, food, and remember this is a big problem for poor households, where food expenditure forms a larger part of their household budget and outgoings. Food inflation is still going up at 10% per year. I mean, compared to the 20% peak that we saw about 6 months ago, that's not looking so bad, but it's still very, very bad. And 10% food inflation is going to be very difficult for some people who are on the borderline of not being able to make ends meet. So it's always the poorest usually that suffer most from these inflationary episodes. It's always good to remember that. So let's look at the contributions to this change, that huge 2 percentage point drop in inflation between September and October. And this is a breakdown of headline inflation, CPI inflation, not core. And you can see there's one component which makes up 1.6 percentage points of that 2 percentage point fall, and that's housing and household services. You might be thinking, I was talking about energy, why are we talking about household services? Well, that's how energy prices feed into our daily cost of living. It's via electricity and gas prices for houses. So household services, a large part of that fall in the prices has been due to energy prices falling. So let's dig into those energy prices. And this is from the ONS report, and there's an interactive graph you can play with. Maybe I'll play with it in a second. But the point here is that firstly notice that electricity prices, which are in light blue, and gas prices, which are in dark blue, notice how they go in blocks, and that's because of the price cap in the UK. That's just the way we choose to change the prices in the UK. The original idea was that it would protect consumers, but during this surging period, it really hasn't done that. What it's actually done is delay the fall in prices and made our inflation look higher than other countries. And it is higher than other countries. But what we're doing now is we're comparing prices a year ago. So this was in October of 2022 here. And if we compare relative to that, yes, you can see gas prices have fallen 31% since that peak in October of 2022. However, if instead of comparing with a year ago, you compare with 2 years ago, well, that takes us back to this point. And over that period, gas prices are up 58%. So remember that inflation is usually measured with this 1 year window. And when you get a shock, prices don't go back down, they accumulate over time. So the cumulative increase in the gas price due to inflation is 58%, and for electricity, 40%. So we're still paying a lot more than we did just 2 years ago. And unless we get deflation, then that's not going to correct, and it's unlikely we will. So just bear that in mind when you're thinking about inflation. Remember that 1 year comparison window. But this is the main contributing factor to falling inflation. This is why it fell 2 percentage points in the headline number. And there's a great thread that came out from the Resolution Foundation today where they look at those cumulative changes in prices. And you can see the energy prices way out here on top. That's for electricity and gas combined. And those are up about 50% over the last 2 years, since October 2021. Even if we look at something like food, that's up cumulatively by about a third. And if we look at things like clothing, catering services, all of these have risen by double digits over the last 2 years. So we're used to a world in which inflation's 2% per year. Now we're seeing inflation in double digits. So that's much more difficult lifestyle change, I think, for many people who'd assumed that inflation was under control and they wouldn't have to deal with this kind of price rises in their lifetimes. So I think one of the kind of more controversial aspects of this inflation print has been the reaction of politicians to the number. So the question really is, did Rishi Sunak fix it, and was it due to government policy? The government, of course, controls spending and taxes. So this is the tweet that came out today. And by reading this, you could quite easily mistaken the fact that inflation's fallen was due to government policy. So Rishi says, in January, I made halving inflation this year my top priority. I did that because it is without a doubt the best way to ease the cost of living and give families financial security. Today, we've delivered on that pledge. And if you look at the actual comments of the tweet, you can see that readers added context, which is that CPI has fallen to 4.6%, as we saw. The government's goal was to halve CPI from 10.7, which it has. However, the fall in CPI is a responsibility of the Bank of England, not the government, and recent drops are due to a fall in energy prices, not government policy. And many people point out that the Bank of England was forecasting that inflation would fall to half of its level at the beginning of this year, and that the government simply piggybacked on that promise, making it look as if they were responsible for the halving, when in fact falling energy prices were what created the fall in inflation, and that was pretty much priced in at the beginning of the year. So you can blame exogenous factors like the invasion of Ukraine, or perhaps a change in behaviour, people going out and being more active, and also using more energy to push up prices, and claim that that's not the government's fault. But then it's not really fair to take credit when, for the same driver falling, prices come down. So blame someone else for the rise and then take credit for the fall. I think that's kind of disingenuous, but not entirely surprising. And also, I love this tweet from John Yarker, who's saying this is actually a scene, if you're not a sci-fi nerd like me, this is a scene from Alien, the movie, where it seems as if the alien's been has been extracted from John Hurt's tummy, and then he starts tucking into a breakfast and everything's great, and you probably know what happens next. The alien comes back, and yeah, it's not a pleasant scene. But anyway, the point is, inflation can spike again. If energy prices rise over the winter, we could see another spike in inflation. So I'd never draw a line under inflation and say we're out of the woods. It's never a straight line downwards. Often there are spikes back upwards. It often comes as a double spike. This is what the Bank of England was expecting. Let me move myself up into the top here. So this is what the Bank of England is expecting. This is the November monetary policy report. And what they expected is usually expressed as a fan chart to express probability, with the most likely outcome here in the darkest orange, and then the kind of tail, upper tail and downward tail and lower tail for their projection also shown, because there is uncertainty in the forecast. And what they were expecting by the end of this year was, sure enough, that inflation would fall to around 4%. By the end of next year, they expected it to fall maybe to around just over the 2% target. So that's their central case based on what markets were pricing into their policy rate. And if you assume that interest rates stay high, the forecast is kind of similar. It falls a little bit faster. So the Bank of England was kind of pricing this in. And in fact, if you read the monetary policy report, they were saying, yeah, we know the price cap is going to end and we expect inflation to fall. I think they said to 4.8. It's a little bit lower, it's 4.6. So that was fully priced into their expectations and also their policy response. So really, it doesn't surprise anyone except maybe some people that weren't kind of clued up to the price cap. So in fact, if we do look at what the government's done, can we assign any credit to the government based on their policy? Now, of course, I said that they have two prongs of their policy which affect inflation. In an ideal world, the central bank and the government would work hand in hand to get inflation down. Now, how can the government get inflation down? Well, the Bank of England does it with policy rates and with policy rates primarily, whereas the government can raise taxes. And although they haven't seemed to raise taxes, what they did at the last budget was to freeze tax thresholds. In other words, as our wages start to increase, which they've been doing very rapidly, what we saw was that wages rose, tax thresholds didn't. So more people were moving into higher tax brackets very rapidly, with wage growth of around 7% or more. So we were paying more taxes. Consequently, the household disposable income fell. And then finally, because people had less money to spend, well, demand would fall and the rate of inflation would fall. So you could claim that by raising taxes, this government has actually helped the Bank of England. Certainly, they haven't been irresponsible. We saw that disastrous budget with Liz Truss, Kwasi Kwarteng, which was going to be very inflationary. They haven't done that. They stepped back. They didn't spend a lot. And so that was good. But you could argue that by raising taxes stealthily, by freezing the tax thresholds, they've actually helped get inflation down. So, give them credit. I think that's true. And I think that probably has helped get inflation down. If we actually look at how much tax we're paying, if you don't believe me that we're paying more taxes, this is the actual report that came out, I think it was last month, showing the tax receipts that HMRC received from April to September. And the percentage change you can see here is relative to same period last year. And you can see that it's gone up by around 50% for income tax, capital gains tax, and national insurance contributions due to wages. So big increases in taxes, income tax, big increase in value added tax, big increase in business taxes because the corporation tax went up as well, remember, from 19 to 25%. So yeah, there's less money in our pockets and more money in the government's coffers. Prices went up, and because the taxes are a percentage of those higher prices, then that will naturally increase the taxes that we pay. If you want to actually see how it varies month by month, it's interesting. These two spikes that you can see every July and January are the self-assessment periods because it's split into two groups. So, chances are you're in the January group, but there are some people in the July group who choose to do their self-assessment at that point. And yes, sure enough, the 2022 to 23 tax take in January was absolutely colossal. So that's because of this stealth tax. Now let's ask the question whether the Bank of England is going to cut rates, because I know that lots of people are paying mortgages, and including us, and so you really do care whether interest rates are going to come down and whether that's going to bring down your refix rate. So for the 1/3 of UK households like us who are worried about fixing their mortgage when it comes out of the fixed period, hopefully this will be relevant. So this is what was expected before we saw these numbers. This was an FT article from, I think it was a couple of weeks ago. And what you can do is you can look at overnight index swaps. These are a kind of swap market, which is a derivative, an interest rate derivative. And priced into those OIS are expectations about what the policy rate will be from the Bank of England. Markets aren't always right, but they're always interesting. So this is what's priced into those OIS markets. The Bank of England is the kind of intermediate line here, the Bank of England's policy rate. The actual policy rate is shown here, and then the extrapolated period is a kind of smooth line in the future. And you can see that markets were expecting the Bank of England would cut rates somewhere around the middle of 2024. And it's the same story for the Eurozone. In fact, Eurozone cutting a little bit sooner, and the US about the same as the Bank of England. So cut sometime around 2024, somewhere around summertime. However, that was before the ONS data that we got today. So before that data came out, the bank rate was expected to be cut to from 5.25%, which is what it is today, to about 4.75% by the end of 2025. So pretty slow falls. That would be about 2 rate cuts. It usually comes in chunks of 0.25%. So 2 rate cuts between now and the end of 2025. After this inflation data came out, the story is very different. The first rate cut is now expected to be in the middle of 2024, and the rates could fall to 4.5%. So that's 3 rate cuts by the end of next year. So sooner than expected previously, but still not super soon. And you've probably heard this analogy that it's kind of like Table Mountain policy rates. It goes up, it stays high until the bank's absolutely convinced inflation's coming back down to their target of 2%. And then, only then, will they start to cut. What they don't want to do is to cut too soon, have inflation get out of control again, and then have to chase it back upwards, because that creates a lot of uncertainty and it could stop the Bank of England being credible. If we look at mortgage rates right now, you can see that they're still very, very high compared to what we're used to. So this is for people with 5 to 10% deposits, house deposits. So the loan to value is 95 or 90%. And you can see that the 2-year fix, the current rate is around 6.2%. And it has fallen a bit. You can see it's fallen by 0.02% over the last week. I don't know whether these were updated based on today's data. It's certainly today's numbers, but I don't know if tomorrow it's going to be even lower. But certainly, if you want to see these yourself, just look on the Rightmove website. But not huge moves right now. Perhaps those will move down more once we get the update of this data tomorrow. But the reason why I think it's kind of important to be a little bit cautious about interpreting this as a huge fall in rates around the corner is this. And this is the services inflation. Remember I started off talking about services inflation being sticky? Well, because of wage growth being as high as it is, that's why service inflation is remaining high. And you can see that if we look at those headline numbers, CPI has fallen a lot because of energy falling, but wage growth is still very high. And then while it remains high and the labour market remains very tight, really services inflation hasn't come down much. And that's still the case. So I think unless that happens, then the policy rate's probably going to stay high until the Bank of England starts to see real moves in this services inflation and certainly core inflation. So this is why I think, it's probably too early to celebrate yet. So positive overall is the way I'd summarise it. Positive overall, but I don't think the government was responsible for the fall unless it was because of higher taxes, which they probably don't want to admit as being the mechanism, because Tories don't like to say that they're the party of high taxes. In fact, I don't think any politician does. But I think that's probably the mechanism whereby they helped. But will the central bank cut rates sooner? I think probably a little bit sooner. But until we fix this high wage growth problem, I don't think we're going to have a kind of substantive move by the Bank of England away from its previous policy. Because remember, it knew this price cap fall would be coming. So really anything that takes us below that expectation would make the Bank of England more likely to cut. But I wouldn't be celebrating just yet, I don't think. So let me just grab Ted while you get your questions together. And let me just mention one thing. We do a weekly market roundup and we talk about inflation in that all the time. So if you are interested in learning more about that, just go to our website PensionCraft.com and you'll see how to sign up for the newsletter. Let me just show you actually, that's probably easier while you just get your questions together. So let's hope our website works. Sure it will. I'll just show you how to sign up for that. I'll also summon the dog. Here he comes. He's got me trained to give him treats. Oh, Teddy. These are his stinky buffalo treats. Lovely. It's good, isn't it? Yeah. Let me just show people how to use the website, Ted. One sec. There we go. That's our website. And if you want to sign up for the newsletter, then you go to free resources. It is free. And you go to the free weekly market roundup. And you can sign up here. It's pretty easy to sign up. And, we've tried to keep it funny. People do say it's entertaining. So I assume they're not just being polite. Okay. But yeah, it's often difficult to see what the read-through will be for investments. It's sometimes not. Teddy, you're pawing it. Go on then. It's often difficult to see what the consequences of a fall in inflation or a rise in inflation will be. So, we try and spell it out. And I think that's quite useful for some people to kind of keep up to date with what's going on. And we also try to keep it entertaining. Lots of gags in there, particularly at the expense of Andrew Bailey. Yeah. You want another one? Just one more. You don't want to be sick. So do think of any questions you want to ask, and if you do a super chat, we'll push you to the front of the queue. If you're one of our supporters on YouTube, yeah, I love you too. If you're one of our supporters on YouTube, also we'll push you to the front of the queue. So let's have a look and see if you've got any questions. Oh, you've been summoned, mate. There we go. Right. Lots of questions about no sound. Yeah, I'm sorry about that. What else have we got? Yeah, so don't forget, please do like the live stream. It helps us if you're watching it in replay. And yeah, do subscribe to our channel. I'll get in trouble with Laura if I don't say that. And we've got a question from one of our supporters on YouTube, Mr. Hanlon. He says, "Hi Ramin, I think the FTSE 100 is trading at around 10 times forward price to earnings. Might be wrong, can't find the info anymore. Do you think UK stocks are unfairly unloved?" Well, it's interesting. I mean, I bought a UK small cap value momentum portfolio. It's a combination of factors. Because I couldn't buy a factor fund in the UK, I rolled my own. So I created a small portfolio of stocks, and I used Stockopedia to build it. And yeah, those stocks are incredibly cheap. As a whole, yeah, the UK market is very unloved because people have just written off the UK as a no-hoper, which I think is unfair. There's a lot going for the UK. It's not just about high dividends. I think it is quite innovative in certain sectors. Usually, what's interesting is we have very little tech, but for the small caps, there is a bit of tech, interestingly. But for the market as a whole, we have very little tech in the UK. And of course, the great success story of the last 2 decades, the last decade at least, has been largely to do with tech, mostly to do with US tech. So yeah, I think the UK is unloved, and I've certainly bought it as a result. But it's not the only cheap part of the global market. US small caps also cheap. They've rallied a lot over the last day, which is a relief. It took a long time coming. And there are other sectors which are cheap as well. Europe's pretty much unloved. China's unloved, but I think it's likely to stay that way because of geopolitical issues. But yeah, I think that the UK is unloved, and I've certainly bought some as a result. In my fund portfolio, my core, of course, is just global stocks, just one fund. But for my fund portfolio, yes, definitely. I've certainly gone long UK there. What else have we got? Do you have any other questions? Okay, yeah, you can also do a super chat. That way we get a... Oh, someone says, I thought he was going to do it all in mime. Yeah, that would be great, wouldn't it? What else have we got? Here we go. So someone's got Actually the Dog, Love Your Name on YouTube. Is now a good time to buy the long end of the curve and lock in rates. I bought T46 in my ISA yesterday before inflation news out of the US, which feels like a win. I wonder how we could look up things like, this wasn't a plant by the way, I wonder how we could look up what T46 is. Oh yes, we could use the PensionCraft trackers, and I've just come up with a new tracker which is a table of gilts. So let's have a look at that. So what this does is, let's just maximise that. This lists all of the UK gilts which are an issue, sorted by their time to maturity. So TN24 matures in this year. It matures next year, sorry, on January the 31st. But you were talking about TG26, I think. TG26, this one. And that one's trading at a price of £93. And if you want to look at the yield to maturity, you can just click on this Wolfram Alpha calculator and it fills in all the fields. And you can work out all of the beautiful bond maths, and it fills in all the fields for you. The coupon frequency, the day count convention for gilts, which is actual, just so you don't have to type it all in. And then when you've got a particular price, this is assuming a dirty price, you can just enter it here and it works out the yield to maturity, which is about 4.2% for that one. Interesting that you chose that one. I wonder why you chose that, because the yield isn't particularly high. I guess you wanted to lock in rates, and obviously if yields have fallen, then you get a bit of a boost for that one. What's the duration of that one? Let's work it out. So the duration is 2.6 years. So if interest rates have fallen by 1%, your bond will have risen by 2.6%. So that's what the multiplier tells you. So yeah, I just wanted to share that. If you're a member of our website, if you're a premium member on our website, then you get access to this tool. And it's updated on a daily basis by my colleague, Patrick. So anyway, yeah, I bet you're feeling pleased about that. Yeah, I spoke to someone who actually bought this bond, which is the ultra long bond, the TR73 bond, the 50-year bond. And let's have a look at the duration of that one. And it's very large duration. So the duration on this one is 29 years. Huge. So if there's a 1% increase in the yield at the 50-year part of the curve, a fall of 1%, then the rise in the value of this bond will be 29%. So it amplifies that yield curve movement a lot. Oh yeah, the other thing we can do is actually look at the price of that bond today. And I'm betting that it's increased quite a lot. So here's TR73, and let's look at it over the last 2 weeks. I don't think it's got the data for, when was that for? Remember the 15th, that's today, at 2 p.m. Okay, so it wasn't a huge rise in the price. Maybe we'll see that tomorrow. But I would expect the gilt market to react, because if inflation falls, obviously that's going to be good for particularly the long duration bonds. But I would expect a rally there. But it doesn't seem to be in the price, to be fair. Yeah. Theory and practice, eh? Anyway, yeah. So that's the tracker, which I think is quite useful. And members tell us it's good. So that's what it's about. We try and make tools which we think our members will find useful. Anyway, back to your questions. And yeah, you can do super chat. You can just you can also support us on YouTube, and we'll push your question to the front of the queue. I'm going to risk a sip of Fanta. No, not choking. That's good. Matthew Mills says, when inflation is going up, it's due to global factors beyond our control. When inflation is coming down, it's due to government policy. Absolutely. That is hilariously predictable. Roger P says, inflation going down is good. I agree. All the negativity when something positive happens just shows the doom mongering of the British people and media. I think that's kind of true. I think people are quite down on the UK. Maybe unfairly. I mean, we're not doing brilliantly, but it's always good to celebrate the positives, isn't it? And yeah, this is definitely a positive. So that's definitely a good thing. Eddie Ward says, yep, inflation coming down can only be a good thing. Core inflation is still quite high though, which is true. 5.7, yeah. Oh dear, a nasty comment about Rishi Sunak. Rishi looks as though he's been halved. That's a sad, sadly negative comment about our Prime Minister, but quite amusing. The Bank of England will not decrease rates until the end of 2024. Okay. Food inflation is still very high. Yeah, absolutely. If a country sustained higher inflation than its main trading partners, will its currency depreciate relative to those peer trading partners? If so, can we expect sterling to devalue versus euro and the dollar? It really depends on what happens to policy and what happens to interest rates as well. So if the UK has stagflation, whereas the US has a lot of growth, which is kind of the situation right now, usually the money will flow to the country with a better GDP growth. So that would tend to weaken sterling. So I think that's, really it's much more driven, I'd say, by growth expectations and also interest rate expectations, but those two are kind of related anyway. And And Eric Bloodaxe talks about the Big Mac index, which is essentially the idea that you have purchasing power parity. Certainly, if you look at the PPP measure, the idea here is that currencies stabilize, or they move towards a situation where each currency has equal buying power. So, I mean, the joke is that you can buy the same number of Big Macs in dollars as you can in sterling. That's what the parity should give you, the buying parity of burgers. But in fact, it's based on a whole basket of goods, usually PPP. And if you look at the one from I think it's the OECD, that predicts that sterling should be a lot stronger than it is now, based on PPP. So, but often these PPP measures of currency exchange rates, it takes a long time for currencies to move to those PPP model expectations. Currency is very hard to predict, is what I'd say. Somebody says, Teddy won't be happy if inflation's increased the price of his buffalo chews. He would not be happy, neither would his dad, but I'd still buy them. You know, they call that elasticity, price elasticity, or demand elasticity. You know, we'd still buy it, even if it was a bit more expensive. He has shares in Pedigree Chum. Yeah, my colleague Michael did a brilliant picture, a cartoon picture of biltong futures, because he has biltong with Laura in her office, and he has the buffalo chews upstairs. He loves biltong. Yeah, he did it with AI. It's a really nice picture. Oh, Lynn says T46, not 26. Okay. So that's a lot more duration than T46. Yeah. So you'd be even happier after the interest rates decrease. You get a much bigger boost with longer duration. Back to your questions. Oh, we've got a super chat from Midnight Sun who says, can bonds rally more than stocks when rates fall? Well, possible, you know, if it's got enough duration. So if you've gone for that 50-year bond, then certainly, you know, you could see a very substantial increase in the value. It depends on how much the yield curve moves and the duration of the bond. But let's think about it. So let's look at so the duration of this bond was TR73. The duration was, I think it was 29 years, wasn't it? Let's have another quick refresher. Duration was about 29 years. So now let's have a look at the yield curve. Actually, the FT's got a kind of yield curve thing. Markets and market data. So this should tell us how the yield curve's moved, and then we can kind of back out a rough idea of what would have happened at the long end today. So there should have been a chunky move downwards. Yeah, so there was a pretty big move. So the latest is here. So we haven't got the 50-year point, we've got the 30-year. So over the last week, it's gone down from 4.79 to 4.63. So let's just work out, so you can actually see my code here. Okay, so this is my R code, which I use to generate these graphs. 4.79 minus 4.63. So that's 16 basis points. We multiply that by the duration, which is 29 years. And yeah, that's 4.6 percentage points gain. So there you go. At the long end of the curve, you'd have been laughing. And we with the 2046 bond, which you've got, that would have still been a pretty chunky rise, I suspect, for a bond. You know, that's exciting for a bond. If we look at the stock market today, let's just see what happened with stocks. Let's look. The US has been on fire, certainly, for similar reasons. They had a a low inflation print. So if we look at the US market, you can see that huge move upwards when they got the low inflation print, a move of about 3%. So it really depends on what part of the curve you're looking at. For the long duration US Treasuries, yeah, there probably would have been a substantial move. Let's have a look at TLT, which is the 20-year plus US Treasury bond ETF. And we'll look over the last month. Whoops, I've exceeded my plan. There we go. How much did it move? Yeah, it moved upwards yesterday, back down today. But yeah, to answer your question, I think bonds are much more predictable in the sense that they react in a much more predictable way to certain types of news. Stocks is often difficult to call, but I think bonds are kind of more predictable in that sense. I've got another question from Parpignon, who says, is US debt a reason for concern or optimism? Concern from recent downgrades and optimism because they don't have any other option than stimulating the economy. I think there's been a lot of concern from the IMF, certainly, that the US is spending too much. And we talked about fiscal policy and monetary policy working hand in hand. What's happening in America, which worried the IMF, is that they're pulling in opposite directions. The US government's spending a lot on infrastructure and on onshoring facilities like chip fabrication plants, which it's hoping to move away from Taiwan onto US soil, and trying to onshore or friendshore a lot of their supply chains. And that's expensive, and it's been funded with issuance of lots of treasuries. So lots of new supply is worrying people because they're worried that the US debt to GDP is too high. And it certainly is high. I think we've got an actual economics screener here on Coifin. I wonder if I can find it. Dashboards, economic, here we go. Yeah. Share again. So this is on Coifin. They've got a debt to GDP ranking here, I think. Yeah, debt to GDP. Japan's obviously way out there, 264%. Italy's also way out there, and the US is now number 3, 129%. So a big move upwards, certainly. If we look at the time series, you can see that over the last 20 years, say. The debt to GDP increased massively in 2008 and then again in 2020 as the government loaded up with debt to stimulate their economy. So you're right, I think. The positive is that they're trying to stimulate the economy very successfully, it turns out. Maybe too successfully because it's probably also stoked inflation. But debt to GDP is a concern. And it does look like the debt dynamics now are just kind of borderline sustainable. The US Office for Budget Responsibility, the equivalent of the OBR in the UK, which is, I've forgotten the name of it. I'm sure many people on here will know, but they actually forecast what's going to happen to US debt to GDP and whether it's sustainable. And currently their estimate is that it's not sustainable, the current trajectory. So the US is going to have to cut back on spending, or they can earn more in terms of taxes. So those are the two ways you can fix the gap. But somehow they've got to close the fiscal gap, the difference between the amount they're spending and earning in taxes. And there aren't any signs that they've done that yet. So that is a worry. The UK, we've got a bit more wiggle room. We've only got a debt to GDP, I think, is around 100%. Yeah, 100.6%. So we've got more wiggle room in terms of how much we can spend to stimulate our economy. But it has to be said, what we've seen so far really hasn't worked. We're expecting stagflation in the UK, high inflation, very weak growth for several years. So not great in the UK. So I kind of agree with what you say, Parpignon. ConConMC says, hi Ramin, Where are we on the investment clock? Oh, I like that. If you're not aware of it, I did a video a while back on the investment clock, which looks at various different measures. I mean, there are various ways of doing it. Let's see if we can find the one for the IFO. I love theirs because this is the German climate index, for the German business climate index, which will appear in a moment, and I'll share this. Okay, and they have a really nice kind of traffic light system, but it kind of illustrates the idea of a clock really nicely, I think. We zoom down. Yeah, here we go. So what this does, the way this one works, there are many variants of this, is on the x-axis, it's got the assessment of the current business situation. So this is based on business surveys in Germany. And then the y-axis is expectations. So the actual situation is on the x-axis, the expectations, the outlook is on the y-axis. So it's kind of like saying, how's business today? If it's very good, it'll be on the far right. If it's very bad, it'll be on the far left. And then the question is, how good do you expect your business to be over the next 6 months to a year? And that's on the y-axis. So at the moment, we're here. So conditions are weak and expected to get worse. So that's the worst quadrant you could possibly be in, I think. But hopefully, we are moving towards a more positive quadrant. So remember, what the place where equities do really well is when you move to current situation below average, this quadrant to this quadrant, because that's the improvement quadrant. Because hopefully then you'll be moving into the boom quadrant. So stocks, the time to buy stocks is when you're kind of here. So you could say, well, that's the important part of the clock. That's the buying part of the clock. But I don't have recent data for the UK. I mean, you can do the same thing for PMI indices in the UK or the US, but I don't have data for that, unfortunately. But good question. I wish I could answer it, but I don't have the data at my fingertips. But that's how I'd approach it with something like an investment clock. But if I had to just kind of eyeball it and just guess based on what I read and what I've kind of gleaned, I'd say that at the moment we're still in the kind of doldrums. So current business conditions are weak, and there's still not. I still think it's not the case in the UK, at least, that we're expecting them to improve. In the US, it feels very much like things are okay, and they expect them to continue being okay. So there may be, in the kind of weak part of the boom segment still, whereas in the UK, weak, and I'd say we're kind of like Germany in the bottom left quadrant, weak now, and the expectations are also poor. But you can read these PMI indices and kind of figure it out for yourself where we are on the clock. But I don't think it looks great in Europe. I think in the US it looks okay. In Japan it looks okay because policy rates are still low and they're finally getting inflation. Things are looking pretty good in Japan and the US, but in the UK, stagflation's on the cards, which is never a good look. So not so good. Okay, so it's now 7 o'clock pretty much, so I think we'll draw a line under it there. Don't forget to like and subscribe. I'm sorry about the audio issue initially. That was my fault. I'm sorry. I upgraded OBS and I didn't check it. And please do support us. Please do like this. Please do subscribe to our channel. Join our membership. Sign up for our podcast, Many Happy Returns, or our weekly market roundup, because that way you'll get free stuff delivered into your inbox every Friday evening when we finish writing it. And I promise it'll be entertaining and we won't spam you with lots of lousy marketing emails. So thank you all for joining us. I hope it was useful, and good luck with your portfolios.